Greetings from our team at Robert and Jones Wealth Management. This is Jack Jones, the managing partner, with our November monthly market update. So we want to tell you that we're looking forward to seeing you at a very full house on December the 1st over lunch at Perry's. We'll have approximately 200 clients in attendance, and we very much look forward to seeing you there. We also hope that you've been able to participate in a number of webinars that we've had over the last few months to keep you informed, things like Medicare, Social Security, charitable planning, cybersecurity, and others. So after a disappointing September, markets are now back to near all-time highs. One of the areas in the market I wanted to focus on now is where PEs are compared to other periods of time. PE measures the valuation of stocks. And what you see 20 years ago, before the dot-com bubble burst, you see the PE was at 25 versus you see it today at 21. So 21 is not inexpensive, to be sure. It's still expensive from a valuation standpoint, but not as rich as it was almost 20 years ago. One other key difference is the 10-year treasury at that point was at 6.2, it's at 1.6 now. So from an interest rate adjusted standpoint, while again, you can't say stocks are cheap, you can say that they're less expensive, especially when you factor for interest rate than they were 20 years ago before the dot-com bubble burst. We're also seeing extreme concentration in the S&P 500 with the highest market cap stocks comprising the top 30% of the weight of the S&P 500. So one way to kind of think about that in context is they are also contributing 30% of earnings per share. So what you wouldn't want to see is an outsized market cap number to earnings per share. The fact that those are at about parity tells you that even though, yes, there's a great concentration of the top 10 stocks, there's also a great concentration of EPS. So Rivian debuted last year, an EV maker, 20% owned by Amazon. What's interesting about Rivian, among other things, they debuted with a market cap of 86 billion, higher than that as we talk today. But that makes them greater in market cap of GM and Ford. So it's just kind of a stunning recognition of kind of EV from a capital allocation and from an interest standpoint. So the most recent jobs number was much improved, 531,000 jobs added, unemployment that ticked down to 4.6, and the revisions of the last 2 months were all positive. So those remain good signs. There are still some mixed signals of 10 million plus job openings. So the jobs picture overall remains one that's mixed and that we're following closely. Inflation remains the big subject, so we'll address that in a few slides here. 6.2% is the highest CPI read in 30 years. And one of the challenges today is that the disconnect between a 6.2, 5.4 when the slide was made, now 6.2, and a 10-year treasury that's only about 1.6 today. That gap is as high a gap as we've seen since 1980. So it's been 40 years since the gap between inflation and where the 10 years has been as wide as it is today. You've also seen kind of a reversal, 2020 versus 2021. Airfare was down 27, up 24 in 2021. Gas down 23 to up 45. Used cars and trucks from down 2.7 to up 45.3. Also, you want to, as we persist in an inflationary environment for as long as we do, you want to own things that are less correlated to inflation. So things like commodities and bank loans. What you don't want to own are things like long US bonds. And so if you look at inflation, if it persists higher, you'll see these kind of stock and bond areas are the things that are typically favored. Commodities, energy stocks, metals, infrastructure, real estate, and even just broadly the US stocks. In bonds, the things that typically do well are emerging market bonds and high yield bonds and maybe some float rate and also some Treasury inflation protected bonds that we've been adding to our allocations, and you'll hear more about that from us real soon. So kind of from an offensive standpoint, to stay on offense with kind of an asset allocation standpoint, you'll own things like commodities, real assets, and REITs. And again, from the bond side, own things like TIPS, things that have some inflation protection and floating rate bonds. So that's kind of a summary of everything that we're looking at present. You'll hear from us soon about an upcoming rebalance to advisory accounts, where we adjust allocations at least quarterly to reflect these changes. Until we see you again, if you have any questions at all, please reach out to us. We hope to see many of you at our December 1st event. If we don't see you then, we hope to see you very soon. Stay well and take care.